Before I get started here, I've been in the market for 45 years, and I've been developing algorithms for the past 20 years. And all my predictions are based on algorithms. I call myself a visionary analyst, and that I research the past to predict the future. So let's get started here. So inflation's chaos, we saw that. Okay, the forecast for these 2022 forecasts are based on my proprietary research of inflation's effect on the S&P's 500's valuation metrics from 1871 to 2020. I spent 4 months doing this research, and the research covers the dividend yields and the PE multiples, the two most important valuation metrics to value a stock. Okay, these are all of my articles. I've launched them in conjunction with this event. You see, they're all dated June 4th. Well, actually, there's one at the bottom, which was the first one I did on my PE multiples research. Due to inflation's effect on PE, S&P 500 declined by at least 41.9%. March 2020, it's so far it's down 14.6%. The S&P 500. That was the first report that I did. Was that one? Okay. These two articles, I'm going to cover the material in them. S&P bottoms occur only when generational investors buy. Also dated June the 4th. And Alpha Centauri algorithm outperforming S&P for 3 centuries, short the S&P 500, June 4th. I want to really compel everybody to read these articles. They're all available at AlphaTech. They're loaded with data. I do not make predictions that are not data backed. These are some of my prior predictions. I predicted all market crashes in the U.S. since 2008. I've been written up by every major magazine. Every single major magazine you can imagine. There's probably 150 articles on my website that were written about my math that I use. Okay, this here is actually, I'll go back here. My favorite of all of my recommendations, this one right here on the right, which is Equities Magazine, have Wall Street's brokers been pigging out. It predicted indirectly the Great Recession of 2008. And the reason why I didn't know I was predicting the recession when I wrote the article in September of 2007, but I wrote an article in 2007, and I said, here's what I said: I believe that there will be a day of reckoning. It will be sooner rather than later, and that day will be ugly for the U.S.'s 5 largest brokers. Within a year, all 5 of these brokers, 2 of them went out of business. Bear Stearns was acquired by, for a fish cake by J.P. Morgan, and of course Lehman went bankrupt, and the other 4 all had to be rescued on that. So, and what was my basis for that? I have an algorithm that detects cash flow problems in big public companies. I've predicted dozens and dozens of large public companies' bankruptcies, and these were just some of them here. That's my cash flow valuation metric. Okay, now, what's AlphaTech? I'll give you this right now. AlphaTech is, I'm the director of research of AlphaTech. Our slogan is growing assets against the wind. We provide educational content on secular bear and volatile market risks, and we specialize in development and deployment of defensive strategies. Okay, here's the secular bears. There's in-depth secular bear information. I consider myself also to be an expert on secular markets. And this is, you can see the S&P since 21 has gone from secular bulls to bears. There's a minimum of 8 years it stays positive, then it goes a minimum of 8 years negative, and on and on. You can see the gains are followed by significant declines. There's 367 to 85, 1,500%, minus 50%. All this is available at alphatech.com. Okay, and here's, by the way, here's your secular bear. This is just to show you up on the right-hand corner. You can get, by going in and clicking on AlphaTech, you get access to all of these videos that will explain defensive strategies, all the history about secular bears. I highly recommend, if you're a discerning investor, whether in real estate or whatever to watch these videos, because secular bears do have impact on real estate. Okay, here's one of my algorithms, which is the bull and bear tracker. It's a long-short algorithm that trades the S&P 500. Here's its performance since 2018. It was originally developed as a crash predictive algorithm, and I converted it into a long-short trend trader. You can see the gains there, 225 versus 51% for the S&P 500. And you can see it excels whenever the S&P is volatile, like it was in 2018, 2020, and just recently, it's up 23% so far for the year. This is a Alpha Edge. It's a hedge fund that's managed by my son. He's here in the room. Ryan, you can wave to everybody. Okay. It had a return last month of 2.8 times the S&P 500, while having a risk factor that was 78% low. It was 78% of the S&P 500's risk. Okay, let's get into what the problem is. Okay, nominal yield and real dividend yields and inflation. You can see here there's a nominal yield. So the S&P 500, this in the month of April, had a nominal yield of 1.57%. When you subtract inflation from it, you get minus 6.73 is the real yield. Okay, here is so all of those targets, these are all of my targets. These targets are updated monthly based upon the S&P 500's yield, and that's updated when inflation is reported every month. So you can see here, these are mathematical targets for the S&P to go to, down 79.95% for the last month. The month before was 81.03 and on. Okay, here is the S&P. Here's the S&P for negative yield periods. So all those negative yield periods which we're now in, you can see the S&P 500, there's only one period of all the minimum 12-month negative yield periods since 1899 in which the S&P had a positive gain, and that was 1.36%. So it's pretty much, if the S&P's yield is negative, the returns are not, they're absolutely, you're going to lose money. Okay, as simple as that. Here it is. Here's one here. I picked this one out because this one, the yield was negative for 176 months. That was from 1968 to 1982, and that coincides with the secular bear that occurred back then. The total return was minus 6.6%. So you went for 176 months, and you had a minus 6.6 return for the whole time period. Here's the inflation rate of that 82 period. You can see here that inflation, which is the blue line, what it did, and look at the volatility for the S&P 500. Minus 37, minus 50, minus 20, minus 28, okay? You really want to live through that. You really want to buy and hold when this stuff is going on. Here is the crashes. So here's what happens. The S&P, what it does is when the yield is negative, there's no floor under it. It crashes until the yield becomes positive. So here's all your most recent crashes. 12/24, 2018, 3/23, 2020, and of course we have it up here. And you can see here by this chart that it reverts back to where it came from when it crashes. Okay, here's notable positive dividend yield period. So it also works the other way. If the yield's positive, here's the annual returns for these periods. The one that I found the most interesting is 1920 to 1934. So this indicator was long the S&P all the way through the Great Depression, and its annualized rate of return was 5.6% going through the Great Depression. That's a powerful indicator. And of course, the highest was in 82 to 87, 42.8% return per annum. Okay, here's another one. Here's the aggregate value of all stocks since 1998 here. You can see here the negative yield periods, aggregate valuations, but all those red bars are negative yield periods. So you can see that for those periods, the S&P gets all of its gains in those periods where it doesn't have the negative yield. Okay, so what happened with this is the S&P 500's dividend yield indicator is overwhelmingly reliable for when to be in or out of the S&P 500 for the 19th, 20th, and 21st centuries. So what I did is I needed to do research to refine this dividend indicator because I wanted to eliminate temporary bouts of inflation causing false positive signals, which there was 39 of them over that period of time. So I created so I wanted to reduce asset class allocation volatility, because if you're moving out of the stock market and into another asset class, you don't want to find out 2 months later or 3 months later that you made a mistake. Okay? So this wound up with the creation, I developed another algorithm called Alpha Centauri. So Alpha Centauri, if you put $100 in Alpha Centauri in 1871 and held it, and just follow what it told you to do, the instructions, it went to $1.08 million is what it's worth now in Alpha Centauri. So here's Alpha Centauri. This is amazing. Alpha Centauri has had 79.6% winners over this entire period of time. It blows all my other algorithms out the door in terms of success ratios. 92% of the time when it's long, the market goes up, and 66% of the time when it's short, the market goes down. Now, here's another amazing thing. We called it Alpha Centauri because look at all the months it's long or short: 132, 129, 163, 198. This is the most reliable long-term investment indicator I've ever seen. Okay? Well, that's a dupe in there. Okay? And that's a dupe. Okay? So it begged the question: how can this happen? How can an algorithm outperform the S&P 500 for 3 centuries? And you understand, the only way that can happen, there had to be a body of investors who created disciplines for that to happen. And so I came up with that. So I went into that, did the research, and here's what I learned. Generational investors are the ones that basically made this happen, okay, made this algorithm so predictable. They're the world's oldest, largest, most disciplined, and longest term, okay? 69 trillion of assets by generational investors held as of 12/31/21. That was 129% of the entire U.S. stock market at 12/31/21. So you can see here, one of them is down here is family offices, $5.9 trillion. Obviously, the world's public pension funds, the biggest long-term generational investor, $56.0 trillion. You got sovereign wealth funds, endowments, and Swiss banks. The oldest generational investor of the Swiss banks dating back to 1790. Now, what's a generational investor's most important? What do they want? A generational investor, a family office, wants to make investments that are going to be safe and also going to generate cash. So what's the best investment to make? Guess what? It's dividend-paying stocks. So here you have Coca-Cola. If you bought Coca-Cola, which they do, and it had a 17 cents per share dividend in 1995, that dividend's grown to $1.68 a share per year. Okay, most recently, it's increased its dividend every year for 60 years. Coca-Cola. So why generational investors are net sellers of stocks when dividend yield is negative? Read the article at alphatech.com. S&P 500 bottoms occur only when generational investors buy June 4th. Okay, here's the Federal Reserve. Here's the next problem. Okay, here's the Federal Reserve discount rates in U.S. recessions. Okay, so this is you can see that every single time the Fed has raised the discount rate since 1914, it has caused a recession. The probability is 100% that we're going to have a recession. Okay, there's only two. You see the two orange dots down there? Only 2 times that the Federal Reserve did not cause a recession. Okay, here it is from all the way to 2017. So it's baked in. It's coming. Okay. Now here's the problem. See the bars on the left. This is inflation versus, this is inflation versus the Fed's discount rate. So what happened, over there on the left where you see the circle, you can see the inflation's skyrocketing and the Fed's doing nothing. It's just the discount rate, they're not raising it. So what happens is so what happened next is they raise the discount rate finally. They raise it, okay, to stop inflation. And then what they do is they raise it during the recession, they raise it again, and they transform the economy from a recession to a depression. Okay, is what they did. Okay, so that was the first Great Depression, 1920 to 1921. GDP fell much further in that depression than the second Great Depression in 1929. We're talking a 33% decline in GDP. We're talking a 32% decline for the S&P 500. Okay, Fed's inflation rate changes. Okay, the inflation rate changes. So here is the Fed from 1925 to 1934. What I want you to notice is the bars below the axes, okay, are deflation. That was a deflationary period in the U.S. There was massive deflation back from 1800 all the way into this period. So what does the Fed? So you can see, what does the Fed do? The Fed raises the discount rate while we have serious deflation. So they basically, they cause serious damage to the economy, but more importantly, because deflation increases the value of financial assets and decreases the value of real estate and real assets, okay? So what they did is they drove the real yields on securities and bonds and stocks, they drove them to record highs. The S&P was yielding 25% back then on the real yield, because it works just the opposite as when you have inflation. So, so what happened? The U.S. home price index, this is the home price index from 1925 to 1929. It steadily declined. Why? Because real property declines in a deflationary environment. Okay? Now, what else did they do? They jacked the PE multiples to a record high, so they created a bubble high for the S&P 500. But this is the same chart here showing the S&P, and that's the S&P's bubble high in 1929. Okay, so here again, you can see here's all the deflation on the left and all the discount rate hikes on the right. They're hiking all the way through a deflationary period. What that did is that protracted. We'll show you here. So here they are. Okay, you can see again deflation on the left and the yellow that you see. You can see here that then you can see over here after the market crashed, okay, then right over here you can see that right above that deflation, right below the S&P 1871 to 2020, that was a low for the S&P 500 for the entire history of the S&P. You can see the deflation, but they're hiking again. They didn't learn from that. They hiked again twice, and that extended the depression. Because why? No one wants to give anybody a mortgage when real estate's going down all the time. There was no mortgages available. They just choked off the entire real estate market. Okay, here is the Fed's rate hikes. January again. I think this might be a Duke slide here. That's through September 29, and there's the PE multiples. I'm going to the wrong. Okay, I'm going to the wrong one here. Okay, now what did this depression? What did this happened, all of their shenanigans? What it did is the depression, what happens in a depression is with deflation comes in, prices no longer go up, and everybody stops spending. So consumption and capital spending plummeted and did not get back to those levels until 1937. So it didn't get back to 1929 levels from 1937. GDP bottomed and did not get back, okay, until 1937 because of that. And here's the U.S. home price index. It declined from 1920 to 1938 by 12.6%. Can you imagine? Okay. Now, the third U.S. Great Depression is inevitable. Why? Because the market and the economy have attributes that are similar to the prior U.S. Great Depressions. The primary causes of the two last Great Depressions rampant inflation caused the first Great Depression because the Fed had to hike in a recession. Extremely overvalued S&P 500 caused the last Great Depression because they jacked it up so high with their hiking interest rates in the deflationary environment. So you can see here is the 2022. This is the inflation rate and the Federal Reserve's discount rate hikes, okay, from 2000 to 2022. And you can see here, look at the inflation spike on the right. And look at where the discount rate is. It's eerily similar to 1919 and 2021. Eerily similar. Where's the PE multiples? Where's the PE multiples of 2020? That's the PE multiple. We by the way, this is the AlphaTac PE multiple. We had to create our own proprietary PE multiple because none of the other ones adjust for inflation. Okay, so we have a proprietary PE multiple, and you can see here that our multiple, you can see here, all-time high in 2022. The Fed made a huge mistake when they did not raise the interest rates when inflation went to a record level middle of last year. What they did is instead of raising the rates to cool the S&P 500, they sent it to its best year, third best year since 1997. And it had more highs, new all-time highs last year, than the entire decades of the 1970s and the 2000s combined. More all-time highs for the S&P 500. They just sent the thing soaring, and we're going to pay the price. By the way, there's the multiple there on the left. The AlphaTac PE is the only multiple that adjusts the PE for deflation. So yes, you can have a negative PE multiple, which is that happens to be the best. That was the best time you could have bought U.S. stocks in the entire last 200 years. Is where you see that negative, that yellow circle down there, when the PE was negative. And of course, here is, I think I've already shown you this one. Oh no, here it is. So here's the other thing that we're up against. In 1929, the discount rate was 6%, inflation was 0, and the dividend yield was positive 2.95. In 2000, discount rate was 5.3%, negative yield of 2.68. Now look, we had a discount rate of a quarter of a percent. We got inflation at 7.48 and a negative yield of 4.86. So it's inevitable. It's cooked. Okay. So the only question remaining with which Great Depression will it mimic? Will it mimic 1920 to 1921, with a 32% S&P 500 decline, or will it mimic 1929 to 1938 at 85% S&P 500 decline? Okay, here is 1918 to 1924. What happened in 1918 is you can see the PE was 26.3 at 8/31/19, the ATPE. The index declined by 32%, and then we see it rallied back by October of 1922. It rallied back to, it made a strong rally back, and the PE at that point was only 6.2. So what happened is that then enabled it to recover, the economy to recover much faster, because the problem with a massive stock market decline is when it doesn't recover, people become fearful and stop spending. They retrench. Cap businesses and individuals will stop spending. So it's important that you get the market back up to within 10% or 15% of the highs as soon as possible. And of course, and they were able to do that, but why? Because the PE multiple was only at 6.2 in 1922. Now the problem with 1929 is the multiple was 6 points higher. It was 32.66, and you can see here, the market crashed by 45%. Everybody thought it was a great buy. When it rallied to the recovery high, the PE was back at 25.8, way too high. So what happened? Then what happens? It crashes again and goes down by 85%. Okay. Do I have time for questions?
So you just went through these two scenarios. So what is your prediction at this point? You said it's 100%, but what is it? You started this with a slide that said that was a 78%.
79.95.
79.95%. Can you elaborate on what you see going on currently?
On the what?
Please elaborate what you see currently. Relationship of, like, you asked this question about which does it resemble more, and you started with this prediction that would be at 79%. So can you please elaborate?
My math is
clear.
79.95. I'm saying to you, I'm not comparing my math to those two those two lows for depression lows, 32 and 85%. I'm saying, pick your point. I mean, the point is it's which one is it going to favor? One of them's going to happen, either 32 or 85. But I'm saying my math corroborates that math. I'm saying 79.95, and mine's been as high as 80.3. Mine adjusts every month. Mine could go back, if the inflation rate soars next month, I could come back and say it's going down 91%. Okay? Yeah, got a question with that?
I can say that for the most part, it's really exciting to see and hear. You made a comment earlier that there's a correlation between what you were presenting and real estate. Can you expound on that in today's terms and relationships so that we understand it, not just in the context of a mathematical figure, but in how it will impact the real estate industry?
Okay, here's what I think. I'm glad you asked that question. I do a lot of research, and I'm saying that I'm going to do some more research, but I believe we're going to see deflation coming. And because a massive decline that is coming in the stock market it's going to stop everything from there's not going to be any money around. Okay, people are going to be, in fact, there was a chart, I didn't show it to you on here, I don't have time to look at it. But what happened is the Fed in 2008, for the Great Recession, they came out and juiced the economy, and it did stimulus, the same stimulus in 2020, because they're scared to death that a massive decline of the market will exactly do that. It will cause consumers to stop spending and businesses to stop spending. And when that happens, you're talking no inflation, you're talking about deflation. And you can see that in my data. You can see it on my chart. I just didn't point it out here today, I forgot to do it. But it was in 2008, you can see the decline, the deflation hit in 2008 was what happened. So remember, the yield's going to go to a negative, it's going to go from negative to positive. That's why, see, these family offices are not buying. A family office and these generational investors are sitting in cash and they're not buying shares. This is all in my reports on the website. So if they're the only buyers, if they have more money, all of the generational than everybody else in the world, and they're not buying until the yield goes positive. Look, you're a fiduciary when you're a family office. You have a responsibility to make sure that you're protecting your assets. You cannot be sitting around waiting 20 years in an inflationary environment and holding assets that are going to get afflicted by inflation. You can't do it. So the family office has a sheer size disadvantage. They're big, but the point is, until the yields turn positive, they're going to sit in cash. I have so many instances in my reports about this. I've just given you sort of like the summary of my reports. So yeah, I highly recommend that you read these reports. They're loaded with data.